and welcome to episode number 35 of Daily Market Mastery. That currently isn't daily but weekly. With me, popular investor Christian Rauchenwald. As always in Daily Market Mastery, we are using Elliott Wave Theory or the Elliott Wave Principle to try to predict and forecast movements in the market, along with a few other tools like the Elliott Wave Theorist, where I just got the most recent episode. Since currently we only have a weekly episode, we focus on looking at how things changed compared to last week in our portfolio. So where we've been right, which of our labelings have been invalidated, and how to adjust. On top of that, before we jump into everything, actually, as usual, you can find all the resources that I'm using. So a link to read the book online for free or get a physical copy, a link to the one-page cheat sheet for Elliott Wave Theory that I'm using, and also a link to all the softwares that I'm using, like Motive Wave and so on, in the description down below. That said, last thing before we jump into it, as always, everything that I share here is obviously my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. Hard word, slip up here. I'm going to share my screen, and obviously this year so far has been going very, very rough. I addressed it in last week's episode already, but I'm going to do it again because apparently some of you, some of you that took the time to leave a comment, which I appreciate, even if the comment isn't positive, didn't watch last week's episode, so we're going to address it again today. Specifically, on the YouTube channel, we had one of our copiers hit his stop loss. I think it's the same one that also left a comment on eToro after more than 8 months. Obviously sad to hear, because at the end of the day, first of all, I'm investing with my own money. So if you have a loss, I also have a loss. Second of all, I don't consider 8 months a long period. I don't know, I'm not gonna force my opinion on you. So let's ask Google, what's a reasonable investment horizon to invest in stocks? Let's see, investments are generally broken down into main stocks, bonds, less risky, longer time horizon. What is a typical investment horizon? Short term, mid-term, long-term, 7 years or longer. That's also not really an answer to that. What's the ideal amount? What's the minimum? Blah, 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 blah. Okay, let's see that. Basics, stocks. Okay, beyond that, with a long-term, blah, 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 riskier types, such as mid-cap, small-cap stocks. These are types of stocks, blah, blah, blah. Right now, we are not investing in individual stocks, but obviously in indices. Do we find indices on the page further down? No. Here to stats. So if you, for example, happen to invest in, I don't know, October, end of October, and you invested 3 months, you would have 20%, another 6 or almost 7%, and then more than 60% in 3 months. On the other hand, if you invested in the end of January, after those 66%, you actually would look at minus 30% for the year. So, but if you, if you invested at the beginning when the portfolio was established, then you would have 30% here in the, 7 months period, 34 here, 45 here, and this year 26. So, minus 26, of course, So, that sucks. It still overall would be profitable. So while this year temporarily so far sucks, it would still be overall profitable. So consider your investment horizon. I'm definitely not somebody that has the time to work out positions that will ensure that every month is green. I'm looking more for the long-term positions. I'm not saying that means that all my positions will only be profitable in a couple of years or so. The past has shown that that's not the case with the way I'm investing. But 8 months is not a suitable investment horizon to copy my portfolio. I think, to be fair, considering my experience that I had, or the experience that I have, considering the past performance of the portfolio, I would say you should only copy my portfolio if you have money that you don't need for the next 2 years or more. Yeah. So 2 years seems like, if we look historically, 2-year period, if you would have started here, well, then it would be +4 -2 +2. So here plus minus 0, then plus 45, then minus 26. So you would be in a profit. If we pick 2 years from here, plus 30, plus 35, you would be in a profit. So like, I think 2 years covers right now based on past performance. That doesn't guarantee future results, of course, but that the results okay. If you're hoping that, I feel like one of the biggest problems is like, if we go to Discover here and we go to copy traders and say view all, and then we say, okay, I want to see somebody that has like high returns. Yeah. Then we see, okay, there's somebody with 3,000% return. You cannot copy him because the risk score is too high, but plus 70% in subscribers. Yeah. So if we just open the top 5 here, let's say top 5. Yeah. I haven't done that before. I've looked at that one before when a friend was visiting and I showed him eToro, but for the rest, I haven't seen them. So just so you know. Okay, so that looks obviously impressive, 600% this year. What happens is obviously a lot of people will try to copy and ignore completely that the history showed completely wiping out the portfolio, completely wiping out, almost wiping out the portfolio, 20% in a month, wiping out the portfolio, losing half of the portfolio, almost wiping out the portfolio, losing more than half, barely profitable, and then this year suddenly 600% profit now. Which can turn around just as easily if we look at the risk score. Yeah, I'm not saying that it will turn around. Maybe that person improved their trading strategy or so. But so the problem is that people usually like here, they jump, oh, there is profit, ignore the past and other statistics. And then on top of that, basically they jump into copying after the positive results were there. Yeah, so assuming that there will be more positive results. If we go to the next one, so real quick, -14 plus 3,000, crazy, and with a risk score that just doesn't make sense. So there is something fishy here with the stats here, 100%, because you cannot have plus 3,000% with a risk score of 1 or 5. Not possible. So that could be that the stock got spin-off, like it happened in the case of AMC, where they have the separate stock APE or the separate ticker APE, and then that ticker, that spin-off that you get, or stock dividend, however you want to call it, basically counts from a 0 buy-in to whatever value it has with a high performance. But yeah, still, yeah, people jumping on that and assuming, I don't know, that there will be another 3,000% month. Yeah. So like, I think the biggest issue is like patience. Yeah. I mean, Warren Buffett said it, the stock market is like an instrument that transfers money from the impatient to the patient. Yeah. And if you're impatient and you jump into, I'm not saying that my portfolio is the right one for you, again, like investment horizon, bunch of other factors, but you should have a decent investment horizon with all of the popular investors, because all of them are investing in stocks, indices, commodities, and so on. So all things that are not gonna guarantee you a return within a year or so, that you should look at like on longer time frames. Yeah. But if you always jump onto copy traders after they had successful months or a bigger success, well, there's no guarantee they will repeat it. Chances are that sometime after a big win, you might suffer some losses. And moving on to the next one here. That one actually has decent 2-year performance. Yeah. That one actually doesn't look that bad, to be honest. PAC 9067, if you want to check it out on first glance. Obviously, I'm not recommending it, so you have to do your own research and so on. Yeah. Relatively high risk score in between, even with 10. So kind of warning sign. It shows drawdowns of up to 62%. So even though most of the months seem relatively well with 230% here and only in quotes -26% drawdown here, but the actual drawdown happens to be much higher with 42% daily drawdown. Yeah. You can also check out the chart here, and that actually tells the story in this case, that probably that guy wiped out his portfolio mostly. And the stats here are then likely manipulated by depositing. Yeah. So if I have a losing month, I haven't deposited in this portfolio. I have a second account on eToro where I deposit more. I haven't deposited in my popular investor portfolio in like years. Yeah, more than a year for sure, or I think more than a year. Actually, I think it was more than a year. So let's check 12 months. Oh no, correction. That was still no deposit, no deposit. Yeah, I didn't deposit for the last year at least. Why? Because it would get your copy out of sync and you would also have to deposit. That's why I have a separate portfolio. But if I would have a losing month, so like now I have an 8% losing month, but if I now deposit 10% funds, it would actually show it as a profitable month because my balance increased. Yeah. So here's something when you check out popular investors. I know my chart doesn't look perfect either. Yeah, like because we're obviously in a losing period right now. Yeah. That's last 2 years. So there we had the huge spike with GameStop at some point, which made the chart still look nice. Now that spike is out of the picture, and now we see, okay, like for the last 2 years, it's been like a little bit of suffering going on. Yeah. So, but yeah, you should keep an eye not just on those metrics because people jump into that thinking that it's profitable when apparently, yeah, every chart that looks like this means there was like a 40-50% loss. Yeah. And then the rest of that is then probably mostly deposits that, yeah. So here's 1 year performance, basically in 1 year minus 9%. It says here, whereas here in 1 year it looks like it's been hugely profitable. Yeah. So keep that in mind. Now next one. Yeah. Okay, that one also looks nice on first glance. Risks were a little high. Copiers jump on the train now that there is like crazy performance. Looking on the chart, that actually looks nice. Yeah. So Melberry, you can check that guy out. Keep in mind high risk score and also insane drawdowns. Yeah. So keep that in mind. Yeah. So he's basically, I don't know. I wouldn't trade like this because we know that if you watch some of my episodes, you see that the trades that I'm entering always have a huge risk reward ratio. So where we risk, for example, losing whatever 20% of the 1% that we invest, so 0.2%, where our profit potential is 100 or 200 or 300%. So we have like 1 to 5, 1 to 10, and so on risk reward ratios, which means when we are right, our profit is much higher. When we lose, our loss is much smaller. He is basically having like very small profits on average and very high losses, but he's right very often, which could be the case because he has a taking profit very early at less than 4%, while cutting the loss only at 30. But again, like from the few that we looked at right now, Mulberry is the one that seems like the most legit to check out if you want to explore alternatives. But again, there's no guarantee, like it's less than a year performance. There's no long-term history. Yeah, so you have to decide for yourself. Obviously, I'm just showing you that the 8-month horizon is not a valid horizon to look at. Yeah. Yeah, next one here, Staggy 73 plus 348%. Yeah, 5 copiers in between, insane risk score in February, for example. January also risk score 10, 200%, which means it could have gone both ways. The drawdown of that guy is not as bad as from the others, but still daily 16%. I think I haven't managed that so far. And profit loss ratio is actually 1 to 2 roughly, or almost 1 to 1.5 or so. So seems better than the last one. If we check out the chart, also looks solid. However, we can also see got it right in some way with high risk in January, February, where the risk score reached 10, and since then sideways movement. So people jump into that and assume then it will go on with like months like January, which is not guaranteed or likely. Yeah, there is nobody out there that that can deliver 200% in a month regularly without insane risk of wiping out the account. Yeah. Anyway, so that addresses the 8-month investment horizon. Yeah. What is the point of all your efforts and smart presentations if you can't simply assess the basic risk of your trading system? I'm aware there is no basic risk. Each of my position has a very specific risk. Yeah. Even if I don't add a stop loss to a position, we actually can talk about that. If you look at my portfolio, you can see that for the SQQQ, we don't have a stop loss set. For the SPXU, we don't have a stop loss set, and it's actually good. I actually wanted to change that and started with the SRTI to set a stop loss, and I did the same with the SDAO. And however, because those ETFs are slightly leveraged, so they don't move 1-to-1. For example, if we look at the whatever, like Russell, not Russell, DJI here, yeah, we see, for example, that we are clearly still below the point of wave 2, yeah, and that's where our stop loss should be. And because that point was in December 13. Now, and that was now the DJI, yeah, so Dow Jones Industrial Averages. So, and if we now look at the SDAO and we set December 13, and we go on the chart and we look for daily, and December 13 should be this one. Yeah, there we're still fine. Yeah, there we're still fine. Yeah. Yeah, but basically because it's slightly leveraged, the movements are a little bit off. So there are, and also it gets rebalanced from time to time, which makes then the movements a little bit more off, or not rebalanced, but split to keep the price above zero, whatever. Yeah. And so setting the stop loss, because while we are analyzing the DGI directly, but we're then investing in something that basically is, in quotes, not the exact inverse, but almost inverse of it. It makes it harder to pick an exact stop loss. I could obviously pick something that's then a little bit further below or so, but to be fair, my projection that I already have, like nothing changed for I don't know how long. Yeah, so my projection since December 21 was markets are going to take a downturn, which is the reason I've been starting betting against the markets in November or December 21. And it's the reason for the plus 45% of last year. Yeah. And I still believe the markets will go down. Yeah. The only thing that happened is that in our SPX position, I addressed it last week. So I addressed it in last week's episode. Last year was quite a challenging year for me personally, obviously. I mean, you might already know it or not, yeah, because like originally I actually spent or lived the last couple of years with my wife in Kiev. And then, yeah, you know what happened in Ukraine. So we actually were forced to relocate. So basically all of this period here, yeah, like from February forward, I really had other things to do than to manage my portfolio. Not that I didn't take care of it at all, but since my outlook is we are going down, I didn't think that I would need to spare time to actually actively manage it during that time. Why? Because my outlook is like this, and I had a lot of other shit to take care of. Simple as that. Yeah. Now, what happened, however, is that I missed that top here. Yeah. So I missed that, labeling that out in the SPX, in the NDX. Back then, we didn't have investments in the DGI and in the Russell 2000. So I missed labeling this and identifying that, hey, we probably are in wave 5 now to close the positions here. Yeah. Now we already, however, like since the comment also addresses that there are huge losses, obviously we have minus 60% here in the SQQQ. Yeah. However, we also have to consider how many profits we took in the SQQQ and in the SPXU and so on. Yeah. So it's not that those are losing positions. It's the same with GameStop. Our GameStop position is at minus 42%, when in fact we took so much profit in January 21, because as a popular investor, I cannot invest more than 25% or 20%, would have to look up the exact number. I think 25 is the limit, into one asset. Yeah. And our GameStop position that I also timed very, very nicely blew up so much that they suddenly made up way more than 25%, which means I was forced to close some of them and take some profit and then re-enter the position. And then obviously it looks like, hey, that idiot invested in GameStop and is down 40% and holding, when in fact our GameStop position from the day I started looking at GameStop and investing is actually at a more than decent profit still. Yeah. And yeah, so it's like always about looking at the big picture. Yeah, so as for the market outlook, so the big thing is, so I said, like, due to personal circumstances, yeah, I missed labeling this out. Otherwise, I probably would have closed the position somewhere here. Yeah. Now we had the development that started like this, A, B, C, which I thought, hey, cool, that's already the corrective pattern. We are reasonably close to the 0.4 of the wave, so there's no point in closing this. We're just gonna wait it out. Then we had it go in our favor, which, oh yeah, cool, that might be then wave 1, and we're waiting for wave 2. Then we had it retrace here, which is like also a decent retracement for 1, 2. So, oh yeah, looks really like, okay, that was wave 2, and now we have like wave 3 in the beginning, and we had it slightly drop here in our favor again, which makes it looks like, okay, that might be the case. So like another semi-confirmation. Well, and then this happened, yeah, and then it's still not it's still not higher than here. So okay, then it maybe is like, or not maybe, but then it looks more like A, B, C, which it actually is in this case, as we can see. So yeah, then we go down from here. Okay, we start going down 1, 2, 3, 4, 5. Potentially, so if we try to label it as 1, 2, 3, 4, 5 as a very small one, which would be wave 1, and now wave 2. So we think that's 1, 2. Well, and then this happens. Yeah. So again, like that's corrective patterns. If we look at Elliott Wave Theory, not the issue, but the challenge is that it's very flexible. It seems very static because it's like 1, 2, 3, 4, 5, ABC. Yeah. but it's actually very flexible in terms of the corrective patterns, which are the ones that are hard to label, yeah, which are the ones that, yeah, like I'm not making a secret out of it. I'm still getting wrong from time to time. Yeah, happens. Yeah, the impulse waves, the 1, 2, 3, 4, 5 impulsive waves, leading diagonals, like this one is actually a leading diagonal. They are relatively easy to label. Yeah, and so with the corrective patterns here, we just had like the situation that okay, I thought this would already be it because we didn't reach 0.4, but we got reasonably close to it in terms of Fibonacci retracements. If I try, I can label this as 1, 2, or A, B, C. So yeah, then we get our fake confirmation here and are like already happy. While it moves against us, we think, oh, that's 1, 2, so it's still okay. Then it moves like this. Okay, shit, but now it looks like A, B, C. So yeah, okay, then that's our wave 2, and we go down from here. Well, shit, we didn't go down. Sorry for my choice of language, by the way. Yeah. Or we started moving this way. So again, it looks like 1, 2, 3, 4, 5. That's wave 1. And now we will have wave 2. And then we have wave 3. So we have this. And again, it looks like, yeah, cool, checks out. Yeah. And now we're waiting for this to happen. But this happens. Yeah. So, yeah, it's just, you don't always get it right. That's the big takeaway here. You don't always get it right, especially on the small scale, and for me, especially with corrective patterns. Yeah. Now, the big point, however, is as I shared, I think in last week's episode, is like that the guys at ElliottWave.com, so Elliott Wave International, the ones that wrote the book on Elliott Wave Theory, or the second book after Ralph Nelson Elliott actually wrote the original, completely agree that it looks, or completely say that it looks like this. Yeah. So we have a combinative corrective pattern, and basically we are right now here. Now, I have the latest episode that puts which I've always also been saying, not just last week, but in the episodes before, I mentioned worst case, we would go around the 0.4 mark or a little bit higher. So in the area of around 4 or close to 4,500. Yeah, I literally have the latest Elliott Wave theorist for me or before me. And yeah, so not sure if it gets sharp, maybe not, but yeah, there you go. Current price. Basically, the target is 4,000 or slightly below 4,500. Yeah. And yeah, so in other words, for the SPX, we expect to go down now. Nothing changed since last week. I know it sucks, but the bigger point was that during this part here, so when we were waiting, or I was waiting for, okay, now we go down, oh shit, we're going further up than we actually should. Why that doesn't check out? Okay, it has to be like this. Well, now we go down. It didn't make sense to close the position, because if I would have closed that position, so like here it's ABC, or it looked like ABC, I expect it starts to go down. Yeah, well, now I don't need to close it because now we are moving down 1, 2, 3, 4, 5. Well, turned out I was wrong. Yeah. Then the next point where it's obvious that I'm wrong is only after we get a new high here. And then it's like, okay, now this is ABC, and now we will go down 1, 2, 3, 4, 5. We start to go down, so there's also no reason to close the position. And then only at the point, even when we're here, it's still a valid 1, 2, because we don't retrace further. So no point to close the position now, because even if we move higher, yeah, I don't know exactly how far. Like in an ideal zigzag, if we zoom in here, in an ideal zigzag, wave C will be identical with wave A, which right now actually pretty much is the case here, but we have no guarantee. So if I close the position here, or whenever we realized, oh, it's gonna go a little bit further, I don't know if I should re-enter here or here. So we take a couple % loss along the way, because in the bigger picture, it's completely relevant. Because if you guys look, so we ended 2022 with plus 45%, and that was from investing. What do we have here? We have here January. So from investing December, so roughly here, till where do we have the next December? Yeah, here's end of the year. So those are half-year periods with the vertical lines. Yeah. So from here to here, we made the portfolio plus 45%. Yeah. And now that was just the first wave of a bigger 1, 2, 3, 4, 5 pattern. And in that pattern, the third wave has to get lower than that channel. Now that channel is not accurate anymore because it needs to go to this point. Yeah. But so that's the channel that will get lower. So which means while we made 45% here, with the following 1, 2, 3, 4, 5 pattern, we actually will get a new all-time low, or not all-time low, but a new low that's lower than what we had in October 2022. And yeah, like, so that's why, while it sucks, I also don't like watching the portfolio and see a shit another month with minus 8%. Yeah, like, I mean, again, it's also my money that's disappearing here. It's not just your guys' money. But if I look at everything, if I look at the past, like, I've been using Elliott Wave Theory for quite some time, and while I'm still struggling with some corrective patterns, not a secret, it has served me very, very well and predicted market movements that others did not see. Yeah, and yeah, so I have no reason to trust or to not trust it now, especially when my assessment aligns with the assessment from the guys that wrote the book. And if we look at the NDX, we have the same situations, like A, B, C. Okay, that's wave 2. Well, turns out it's a combinative corrective pattern, and instead of like turning around here, it started turning around, so no point closing. Oh, it gets invalidated, and I'm like a little confused how the corrective pattern is, but we're still below the point of wave 4, so we wait it out, and then suddenly we have that rally here. Yeah, like, what's, by the way, important about those rallies is, yeah, if you bother to look up the stocks that are rallying, or if you bother to look up the Nasdaq, you will see that only a handful of stocks are actually going up. So it's only some technology stocks that are pushing the index up, whereas the majority of stocks in the index is already bearish or barely or moving sideways. Yeah, so it's just kind of like the blow off top. So you wait for those few stocks that are like, again, Facebook, Apple, and whatnot, to finish their rallying quotes, and then they don't have the energy anymore to prop up the entire index, and then you have suddenly your downward movement again with a 1, 2, 3, 4, 5 pattern that again has to go below this channel here. Yeah, obviously not in a day, but 1, 2, 3, 4, 5, and suddenly we are again below 10,000 in the NDX. Yeah? In the DGI, we have, I mean, there we just recently invested, and there, basically, yeah, I could have waited a little bit here, to be honest. So I could have tried to label out this better. I'm not 100% sure on which day we invested. I think we got in somewhere here, or maybe we got in somewhere here, but I think it was somewhere here. And the idea was that might already be a small 1, 2, where we will now say with 3, 4, 5, yeah, which turned out to be wrong, because that apparently, yeah, if that's 1, 2, 3, 4, yeah, it doesn't work out like this. Yeah, so here, honestly, like, we'll have to look closer, but not the purpose of this. The bigger point here is the same thing. The overall outlook is still bearish. It's still, in my opinion, going to be like this. That's wave 1, that's wave 2. And in the opinion of, like, in my opinion, I actually thought that's wave 1, to be honest. Yeah, so that we have like a leading diagonal 1, 2, 3, 4, 5. But the guys at Elliott Wave International think or say it's like this, and they have like decades of experience and not just one person labeling, but whole teams. So I'm going to take their word at it that it actually is like this, which means we're expecting the drop here. There's going to be a few other things that we're going to look at that will give you an idea as why the drop is coming. Yeah. Yeah, in the Russell, it's the same thing. So the Russell, for example, is basically, unlike other indices, it contains 2,000 different stocks. Yeah. And there's barely any upwards movement, and the majority of stocks in there are also barely moving up and actually sideways or moving down. And a few stocks keep pushing it up right now. Yeah, but we already see that there's low energy. And if we look at the labeling, we see 1, 2, and now we have 1, 2, which means that will be 1, 2, and then we have the third wave of a third wave of a third wave, which means actually the drop is imminent. Which means also, while it sucks that I missed the beginning of the year, yeah, that I missed or not the beginning of the year, what do we have here? October, yeah, end of last year, that I missed the high here, because again, like, we had to find a new apartment, we had to get registered, we had to set up a new company, we had to actually find the time to drive to Kiev and clean out our apartment there and so on. We had to deal with a million other things here. So like managing or like micromanaging the portfolio, to be precise, simply wasn't a priority during last year. Yeah. Even right now, I mean, it actually blows my mind, but we're now here for 1 year and 4 months in Germany, and we still have a few things that are just moving so slow and constantly take up time and energy that need to get sorted out on administrative sides. Yeah. And anyway, so here yeah, like I missed it. Yeah, I suffered for it. And then once I started looking at it, it actually looked like, hey, the correction is already over. We start to go down. Yeah. And turn out I mislabeled the corrective pattern. And that's why we are looking at that temporary loss. But every pattern in every index, so SPX, NDX, DJI, and the Russell, all of them point towards we are going down. Yeah, like, I mean, to be fair, if somebody, so I mean, obviously it's your money, you do you, yeah. But if you are right now looking at a 27, 28% pending loss or so, yeah, yeah, what difference does it make to again, you make your own decisions. I'm just saying from my perspective, what difference does it make to risk another, I don't know, let's say 5%, and see how the next 2 weeks develop? Because there is simply, in Elliott Wave Theory, there is simply not much more room to go up. Like the patterns played out, that pattern actually looks quite perfect. So we should actually expect, there are like, what, 9 trading days left in this year. Today the market is closed, not in this year, but in this month. Not in this month. Actually in this month, or not aware, no calendar here, yeah. So we have 4 trading days this week, and then, oh no, there are actually really just 9 trading days left in the month, yeah. And then that month is done, and then even on a monthly chart, the pattern should be relatively complete. So starting July, it's actually what I also shared last week in the stream. Starting July, we should then see our profitable months develop, yeah. And if July still is a losing month, then apparently I have been wrong. And I have to go back to the drawing board. Yeah. Now looking at, because the comments that I saw on eToro and also on YouTube, they addressed that whatever, like Elliott Wave Theory is an outdated theory, an old theory or so. Like like in my personal opinion, yeah, Elliott Wave Theory is the most accurate thing that you can use. The only challenge is the flexibility that the corrective patterns offer you, because while there are only 3 impulsive patterns that are like 1, 2, 3, 4, 5, and are very, very similar in quotes, there are a total of, I don't know, 9, if I have it right, 9 corrective patterns and combinations thereof that make that one harder to label. Yeah, now we can get rid of the line. Yeah, now, but looking at Elliott Wave Theory, so let's take a look at what else we have, and I'm just going to look at what we have in our portfolio, and I'm going to do it based on where we are currently at a loss. Yeah, so Disney. So Disney we labeled. I'm not sure if I think we had a 2-day chart, but yeah. No, we actually had a monthly chart. Yeah. So Disney looks like this: 1, 2, 3, 4, and 4 finished here, and we're currently at a loss of 6%. But we're looking at a monthly chart, which means each candle here reflects 1 month. Yeah. Our risk-reward ratio is insane, because if we are right, we have to at least recover 70%. That's like 100% upside. If we are wrong, our stop loss should be at 84.07. It's actually a little bit lower. It's at this point here 79.7, because if that's wave point 4 of the previous wave, we shouldn't get much lower. Yeah. Now, possible that we're wrong here, but the risk reward ratio is great. Yeah. Right now we are at minus 6% of that position. Yeah. So not that great. But moving on, next position where we are at the loss still is Black Knight Inc. Yeah. I mean, that one I mentioned last week. Possible that it turns out that I was wrong here, but either. If I was right with 1, 2, 3, 4, 5 impulse followed by a corrective wave 2, our stop loss is at 52. Our risk reward ratio is again great. I think our overall risk here is 10% of the 1% that we invested, or 2% that we invested. So we're talking about 0.2% risk. However, if we're right, Black Knight Inc. over the next couple of years should make a new all-time high. Yeah, so we're talking again more than 100% upside of the 2% that we have invested. But again, 0.2% risk, more than 2% upside. And again, that position is right now at minus 5%. And here we're looking at a weekly chart. So again, it takes weeks for new candles to develop, or 1 week per each candle. So it just takes time to wait and see if we're right. Yeah. Now then, if we look further, so the things that we looked at individual, Goldman Sachs. Yeah. In Goldman Sachs, we're currently up 5.8%, and we have a similar pattern. We say, okay, this is 1, 2, 3, 4, and now we're in wave 5. And then here, probably it could already be 1, 2, 3, 4 with 5 in progress, but that would then not be the big wave pattern, but that would be a smaller wave pattern. Yeah. So, and again, we should at least recover 70%. Our stop loss in Goldman Sachs is at 277.84. So here with wave 4, because if we hit that, and with that, our risk is, I don't see the percentage right now because the markets are closed, but our risk is very limited. Yeah, from when we opened the position at 319, where our profit target is very reasonably big. So we're looking at like in most, or at least recovering 70%, but in most cases actually having a new high. Yeah, so we're again looking at close to 100% upside with very, very little downside. And actually here it already started to play out in the way we thought it would, or I thought it would. Yeah, moving on, next position, Domo. In Domo, yeah, I have to deal with my data source at some point. We have a very big labeling where we say this is 1, 2, and now we're in wave 3. And then we have like the 1, 2 here, and we actually had a position from here to here and took a profit and then re-entered here because again, I thought this is ABC when it turned out that likely is ABC. But we already took profit in Domo, so from the trade up here, yeah, because it was just perfect timing with the streams to get in here and then notice, hey, that actually looks like this. And overall, we're right now at 7% profit. And if we're right again, then this was wave 2, which means wave 3 has to go outside of this channel, which means, again, we have a great risk-reward ratio because our stop loss is at 12.04, should be. Let's check. Domo, stop loss 1169. Sorry, we used that 0.4, 1159, 69. I have to adjust that. I have a typo. Can I markets close still? Yeah, 1159 should be that. So we have 16% risk on one of the position and 21. So on average, we have like 17% risk on the 2% that we have invested, or 1 point something percent that we have invested, with our upside being again like 150%. Yeah, 10 times. So 1 to 10. And right now it plays out the way I expected it would, with the only exception that I thought this was already the corrective pattern. When it turned out, okay, we entered a little early, could have waited a little bit. Yeah. Obviously, we'll see over time. That's a 2-day chart. We see over time over the next 2 or 3 months if we get a new high and I actually here in progress of wave 3, or if we somehow have a downturn and a turnout wrong. Yeah. I mean, so far it looks like I'm right. Moving on, next position, Ford. Ford, we're currently up 14%, yeah? And that one I already labeled around here in a very old episode, and it was episode, you can check it out. Ford was episode number 8, yeah? And that was on the 4th of April. And we opened the position also on the 4th of April. And I have to go back here. So on the 4th of April, so here, yeah, could have waited with the opening, but in the 8th episode, we already recognized, okay, that's likely a combinative pattern with ABC, then a reactionary wave X, and then contracting triangle. We're already weeks before we had that point E, roughly, not to the cent, but very, very relatively nicely mapped out as, okay, here we will have likely our turnaround to go up. Yeah, originally we thought it was here, but the price difference here, it's 1144, and then eventually it was like, what, 1124, really neglectable. Yeah, and so far it looks like this plays out as a very small 1, 2, 3. Now we'll have a 4, 5, which will be a very small wave 1, 2, 3, 4, 5. Yeah, and that will be wave 3. So we're again in a third wave. So here we are currently in a first wave of a third wave on a very big degree. Yeah, and again already up that position 14%. And once we have the wave 1 here confirmed and a wave 2, then we will probably increase the position for wave 3. And then moving on, NEO. Yeah, NEO we labeled on the in episode number 21 on the 16th of May, and in NEO we are currently up 19%. And in NEO it's a little tricky. NEO is the one that we may get wrong. Yeah? So to be honest, like that's gonna be that's gonna be the one where I'm not super. I mean, not confident, but you know, it's not like with the ones we just looked at, yeah? Because here the labeling would suggest that it's 1, 2, 3. Now we have wave 4. Wave 4 cannot go lower than 0.1 because on the biggest scale, we should always be looking on an impulse pattern, yeah? And if that's the case, our stop loss is at 565 or so, with our take profit being a new all-time high. So if we're right here, again, great, because it would be insane profits over the next couple of years. If we're wrong, our loss is very limited, yeah? And then I think one of the best examples for Elliott Wave Theory was IEP, so the Carl Icahn Enterprises, yeah, where we looked at it, IEP, we looked at it in 2 episodes. We looked at it first in episode 16, where we looked on a monthly chart first, and we actually had the data fluke. So if you check out episode 16, you will see that and we're missing data here right now, so I have to quickly update the data sources. Like someday I'll figure out how to do that it works for wrong button, that it works for everything. So we have to add the historical data here from Google to get the previous past data, and if we do that, however, it breaks the data on the SPX. Yeah. So, but if you check out the original episode, which was episode 16 on the 2nd of May, then we had actually a fluke that this candle or that candle here went down to $10. And considering that in Elliott Wave Theory, very often wave 2 retraces into the area of wave 4 of the previous impulse wave of a lower degree, and wave 4 showed us at $10, we actually said, okay, it will likely go down to the $10 mark. Yeah. Now, with the updated data sources, we actually saw, okay, that's a fluke. So we actually then saw, hey, 1940 is where it would turn around, and we caught it a day late. So if we switch here, or before we switch here, keep in mind that in, what do we have here? May 1st. So yeah, let's switch to daily, 2 days again. Yeah, 2-day chart, April. So somewhere here in that area, obviously, Hindenburg Research published their piece about Icon Enterprises, and that it should be valued at $10. Yeah, and then we had the drop, blah blah blah, and we were actually able. We missed it by day because the stream was later when we reviewed it. Yeah, but we actually entered our position here thanks to Elliott Wave Theory, not thanks to anything else. On the 6th, and the 6th is what, 6th of June? No, did we enter that late? There. So like either this candle, since we are looking at 2-day candles, we entered at where do we see price 22? Yeah, so we entered actually 22.99, so somewhere here. And based on, okay, now we have that ABC pattern finished, and we have something else that points towards, again, using Elliott Wave Theory, not using Hindenburg Research or anything else. We have something else that points towards, hey, we're done here, and that is that wave 4 point here, and it's the 61.8 retracement, which again, wave 2 very often will retrace to the 38.2 or 61.8 retracement, or in that area. Yeah, there are exceptions to that. Sometimes it goes further and so on, and it went a little further here, but we have 2 points that tell us, hey, most likely that's the turnaround point. And yeah, originally in our original review, we had the wrong data. We had actually the $10 wave 4 here. So yeah. But yeah, like using Elliott Wave Theory, we found some very incredible opportunities that are, with the exception of Disney and Black Knight Inc., right now all profitable and show insane profits for the short period. Again, we're talking about the last 2 months, and in the last 2 months, we have positions that are up between 5.8 and 21%. Yeah, and it's all using Elliott Wave Theory. It's not. I might use Hindenburg Research to say, oh, now I'm going to look at Icon Enterprises because now I expect that we're in a corrective wave, or that a corrective wave or a drop starts, but I then use Elliott Wave Theory to determine my market entry. If I would use Hindenburg Research, they think Icon Enterprises should be valued at $10 and everything else is overvalued, which means I would only be able to buy it below $10 if I would use them for trading. But by using Elliott Wave Theory, we found the market entry. We missed it a little bit again because in the original research we had the wrong data, unfortunately, and then we caught it like 2 days or 3 days after we had the low, but we still got it at a nice time. Technically, we could have gotten in, I don't know, like, I mean, potentially at the 0.4, so at like $19.40, so $2, 10% cheaper, but will not complain. Yeah. So in other words, Elliott Wave Theory hasn't let me down in the past ever. My portfolio shows that, I don't know, long term, my performance is more than decent. And yeah, like the only thing what we have here is basically 1 break-even month, 5 losing months that suck, mostly because of, I don't know, bad luck, me missing to label the pattern already in November as completed or December, and realizing, okay, it's time to take a break or take counter trend positions. Yeah. And in combination with, as explained earlier, that then once I looked at it, it actually looked like, okay, we're already complete. So now at whatever, minus 15%, no point in closing it because now we're going down. Yeah, and now at minus 20 or 18%, no point in closing it because now we're going down. Yeah, and turning out to be wrong with the corrective pattern. Yeah. Anyway, there are a few other things. So like I've been sharing a lot now, so overall our positions are actually doing good. Obviously our SPX and NDX positions are not doing that good, yeah, and we managed due to like wrong stop losses to have a few positions in the, I think, STRY closed and SDAO eventually as well. I will adjust that tomorrow when the markets are open, and especially then like increase some positions. Yeah, like, I mean, don't get scared, or if you get scared, then consider cutting your losses if you don't trust what I'm doing. Perfectly fine. Personally, I will increase certain positions or at least adjust them. And yeah, to point out something else. So since I have set the latest episode of the Elliott Wave Theory theorist in my hand, that and they use other things to point out or to support Elliott Wave Theory. Yeah, like so. What do we have here? Yeah, so there is the trading index TRIN. Yeah, like I'm gonna actually show you that. Deskcam. So you see that. Yeah, I have to fold it a little bit because otherwise it's in the way. So you see that trading index that is in the lowest in 8 months. Yeah, so it's not getting too sharp, but you see it's the lowest in 8 months. Yeah. Now that trading index measures the volume in stocks up on the day versus the volume in stocks down on the day. A high TRIN indicates elevated selling pressure, and a low TRIN indicates elevated buying pressure. The keyword there is obviously elevated, which means that the buying pressure is already too high, which means that people are using a lot of money right now to drive up the indices relatively little. Yeah, so if we would have a very high TRIN, it would mean like people are basically spending little money, and therefore markets would drop by definition. But when you have the point of the blow off right now, people are spending a lot of money but causing only little movement, and most of the stocks are already experiencing sideways or downwards movement. And in every index, it's basically a handful of very popular stocks, yeah, that everybody knows, that are still going, or that were responsible for pushing up the gains. If you look into the SPX, I think like the top 7 stocks are responsible for the entire gain this year, where the rest of the 400 of the 500 stocks in there actually accomplished a combined 0% year to date. Yeah, so something like that. Yeah. Moving on, another point that supports like that we have an imminent. It's not a crash, a first wave down, second wave, but then it turns out to be a crash. Yeah. So. Which camera do I use? I'm going to use I'm going to just share it from the Elliott Wave Theorist. So I can also show you the chart then on Motive Wave, but yeah. Wrong button, desk cam. Yeah, so here we have the pre-crash, pre-crash level, blah, blah, blah. Yeah, so if of the FIX, so the thing that measures volatility. And you can see that it's while that's the SPX going up, yeah, that's the Nasdaq's going up. That's the Nasdaq, yeah, and down here we have the volatility index, the VIX, yeah. You can see that before the March 2020 crash, the VIX was at a low of 13.38 here, yeah, and we can see that we are now at almost the same low. So basically, in quotes, crash, or not crash, but turnaround imminent. Yeah. To read that to you, obviously, probably I shouldn't, but you should definitely consider checking out the Elliott Wave Theorist for yourself. It's like $30 per month or so. And you really get like incredible information, in my opinion, for the broader market outlook. Yeah. The VIX indicator is a measure of complacency versus fear, with the lowest readings indicating extreme complacency. As you can see in figure 10 that I just showed you, investors are currently expressing the most lackadaisical attitude towards stock market risk in 40 months. Today, June 16, that's when the episode was written, the VIX slipped to 13.48. This is the lowest reading since February 14, 2020, when the VIX made a low of 13.38. That reading occurred 2 trading days before the Standard & Poor's high, just prior to the stunning stock market plunge that took place in February to March 2020. Even at the US stock index's all-time highs in November 21 and January 22, VIX never got that low. Blah, blah, blah. Blah, blah, blah. Yeah, I'm going to skip that part. So, yeah. Media pundits are gushing with the optimism implied by the low VIX and the high DSI. Here are some headlines from recent days. mother of all melt-ups. It's official. We're in a bull market. S&P 500 starts a new bull market. Don't fear the bull market where stocks are heading higher. Here's how long the bull market might run. New bull market has legs. Stock market bulls are in the driver's seat. The bulls finally control the stock market, and so on. And those are like headlines to tell you from which Bloomberg, CNN, Wall Street Journal, Barron's, US News, Yahoo Finance, Wall Street Journal again, and MarketWatch. And then Elliott Wave Theorist adds to it how this market qualifies as the mother of all melt-ups. I have no idea. If you want to study a real melt-up, blah, 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 okay, yeah, blah, 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 I'm going to ignore that. So it's not important. Further on the complacency front, investors' intelligence just reported the most bulls, 51% among advisors since November 21, the month that the Nasdaq and the broad market indexes topped, and the fewest bears, 21.6% since early January 22, when the Dow and Standard & Poor's topped. Only 1 out of 5 advisors polled bearish. So right now, only 20% of advisors are actually thinking that the markets will go down. Fitting the general mood, a poll of 3,000 homeowners, blah, blah, blah. So there are also 57% of homeowners that are positive about the personal finance. Which is the highest level since the fourth quarter of 2021. And again, that is when both the Nasdaq and the broad stock market index made their all-time high. As chapter 2 of Elliott Wave Principle, again, you can get the book by following the link, either read it for free online. Second wave rallies, as the book explained, second wave rallies recreate the optimism of the preceding major top. That is just what we are seeing here as wave 2 stretches towards its peak. There are a few other things, but I don't want to quote the entire Elliott Wave Theorist because it's a paid subscription, and therefore like giving you teasers is definitely okay to get you an idea of like what you get if you check it out. But sharing the whole thing with you would be like not so good. So overall, what does that mean? I mean, today's episode is way, way longer than expected or than planned. But what does it mean? It means that, I'm fairly confident in our portfolio. I know like right now, some people might be wondering like, what the fuck is this guy doing? And how the hell, like we're approaching minus 30%. Like wiping out a lot of the profits I made over the last couple of years. And the big question obviously is like, how much can we recover? By the end of the year. So if I'm right, but then we also have to consider that originally, so we accomplished those minus 28% or whatever we are right now by investing in the SPX and the SQQQ. And once they turn around, those positions obviously will head towards a break-even point and eventually to a profit point. And assuming I'm right, of course. But now we also have investments in the against the against the Dow Jones and against the Russell 2000, which means, well, those also initially suffered a loss because we entered them not a little early, but just right now, and we're still suffering the last couple of days of the upwards movement. They will add to the profits on the way down, which means we will recover the losses before we actually need to have a new low. So we don't need to see what was the level in the SPX, the level in October 22 level to already be back in profit. Obviously this year may not be as astounding as last year was, but I'm fairly certain, considering the sentiment, everybody's screaming it's a bull market, if things are going up, and like buy, and so as a result, once the turnaround happens, people will just watch at their huge losses, in my opinion. And while our portfolio will actually move towards decent and ever bigger profits. And the funny thing is going to be that with that movement down, so once we have the movement down begin, it's also going to subdivide in a wave 1, 2, 3, 4, 5, which means when we have the first wave 1 drop and then a small wave 2 recovery, people are going to be, okay, now I'm going to double down, I'm going to buy more because now the dip is over. And then we have the wave 3, which will be the strongest movement down. And then people will very often either then start selling at losses or they will double down even further. And then probably only once we have the third wave finished, which takes us below the point in October 2022, only then will some people realize, okay, it looks like we might go down further. And then it depends how fast the whole thing plays out. Again, we're usually looking at a 2-day chart, so it's gonna take a relatively long time. We're talking about months for everything to play out. But yeah, I'm fairly confident. I really feel like, I mean, I'm no Michael Burry here, especially since I'm also relying in my research on other professionals like the guys from Elliott Wave International. Yeah. But I really feel a little bit like Michael Burry in the movie The Big Short, when basically everybody called him an idiot, and he then just stated, yeah, I'm not wrong. I might be early, but I'm not wrong. And I feel like same thing here. And I wasn't even early. I actually placed my bets against the market, if we take a multi-year outlook, perfectly in November and December 2021, when the market started to turn around. So like, I mean, couldn't have timed it much better, to be honest. And the only thing that happened is, again, like personal complications. And then when I had the time to analyze it, it was just, yeah, like there, I got it wrong. I got wave 2 wrong, which is why we are enduring that counter trend move instead of leaving or closing the position early. Yeah, but now there's no point in closing them. I mean, obviously, if we move much higher or so if it turns out that the labeling is completely wrong, we move much higher, so well, then I will look like an idiot. Yeah, and I will take the loss, and it will also be loss on my personal finances. It's not just your guys' money or so. It's like I'm also invested. So, and then I'm gonna wonder, like maybe it would even get me to question Elliott Wave Theory. But so far over the years, I have not a single reason to question Elliott Wave Theory, because it's always served me well. And we'll see. As long as that stays the case, I don't have a reason to question it. I get that it's hard. If you invest, you trust your money to somebody, and you then see it minus 20, minus 25, minus 28, for all I care, minus 30%. Yeah, that you're like, hey, what the fuck's going on? Yeah, and it's then hard to like justify, okay, should I copy further, or should I cut my losses and move on? And I cannot make the decision for you. You have to make it for yourself. I just, yeah, like did my best, I think, today to try to provide you with the bigger picture of like why those minus 20 something percent happened, because of like a mix of like, yeah, lack of time, and then, yeah, like just getting it wrong. Nobody gets it right all the time. But why, in my opinion, leaving now would be a very, very bad decision. Yeah. So, but it's just my personal opinion. Again, like consider your own investment horizon, consider your risk appetite, consider if what I shared with you in this live stream / video makes sense to you or not. And then based on that, consider if you want to cut your losses and move on, or if you maybe want to add money to the account, because we are very, very close, in my opinion, to the turnaround point. Again, but you need to make the decision for yourself. You obviously should never invest money that you cannot afford to lose. And you should obviously always do your own research. As I said in the beginning, at the end of the day, it's your money. Yeah, because just because I'm able to live with a 28% temporary loss and I'm convinced that we will turn around, doesn't mean that it will happen. Yeah. So, yeah, make up your own mind, make up your own decisions. Anyway, even if you, if you have questions or so, you can always leave them in the comments down below, of course. Sorry for today's episode being much longer, but it felt like, since some comments were out there that asked specific questions, that I have to address everything again. Moving forward on Mondays, we will just focus on looking at the weekly progress. And and then actually, to be fair, the way how things looking right now, I'd either expect that next week or the week after that, we have 4 trading days this week, 5 next week. So actually, so I actually think within the next 3 episodes, which is the next 3 weeks period, that we will start to see the turnaround happen that we're waiting for. Yeah. So, which is something I've already said the last couple of weeks. I mean, there I didn't say last 3 weeks, but I said by the end of June, and then July we should have be in the right direction. I understand that originally I also said that, okay, this is ABC and we will turn around now, and it turned out wrong. But again, that was my personal opinion, me labeling, and everything now is additionally backed by the opinion of all the analysts at ElliottWaveInternational.com. So anyway, yeah, you. Thanks for tuning in. I hope you were able to take something away from this. And yeah, if you're still copying me, thanks for your trust. And if you're moving on, then yeah, that's also fine. I wish you all the best in the future, and hopefully you find the popular investor that fits your investment horizon and risk appetite better than my portfolio. Yeah, and that's it.